And we're live. Hello, everyone, and welcome to today's panel discussion Carbon Markets and Beyond from Pilots to Scale in Sustainable Agriculture. Today, we will distinguish between offsetting beyond the value chain and insetting within the value chain and explore how both are being used alongside green financing to support scalable, transparent, and measurable sustainable agriculture practices throughout the supply chains globally. We're calling it Beyond Carbon Markets because we think this conversation is bigger than just offsets. It's about how sustainability becomes embedded across entire agricultural systems, from farming practices to financing. It's about emissions, yes, but also resilience, traceability, and access to capital. This conversation will be a 45 minutes discussion, and we will allocate 15 minutes at the end for Q&A. So we are please feel free, everyone, to type your questions in the chat at any time. We will also live streamed on and recorded across our YouTube, X, and LinkedIn channels. So I'm Champs, and I lead carbon finance activities at Climate, a global climate data infrastructure and analytics providers. And I have the privilege to facilitate today's conversation. As we've seen, supply chains have been heavily disrupted in the past few years, from external shocks like war, drought, and frost, to new regulatory pressures around emission disclosures and sustainable sourcing. And it's become obvious that we need to shift toward measurable and financeable sustainable practices across cropping, harvesting, transport, and all the way to end use. And yet, if despite growing interest, and if we are to focus on the voluntary carbon market, regenerative agriculture and soil carbon projects still account for less than 2% of total nature-based solutions credits issued globally in 2024. And today we're joined by an esteemed team of panelists. We have Nuala, agribusiness lead analyst at world-renowned S&P Global, Leon, head of carbon trading and finance at European financial leader Rabobank, and John, CEO of the Climate Labs, a global provider of climate and nature analytics and monitoring solutions. Good morning, good afternoon, and thank you all for joining us today. Well, let's kick it off and let's start the conversation. What would be good is to start by some kind of providing context and definitions. So what is sustainable agriculture, and why is it becoming a central tool for emission reductions, especially around Scope 3? And I think I'd like to start with you, John.
Thanks a lot, Chams, for that great introduction, and it's fantastic to be part of this esteemed panel, like you mentioned. So I think other kind of decarbonization activities tend to get a lot of attention. So it's worth just kind of level setting to set the scene in terms of agriculture's climate impact. So I'm sure everyone is familiar with the statistics that half of our habitable land is devoted to agriculture. It contributes, the food system, that is, around 30% of global greenhouse gas emissions. 90% of tropical deforestation is due to agriculture. But you also have all these other kinds of impacts, like a leading cause of biodiversity loss. In some countries, 70% of fresh water is devoted to agriculture. Actually, that's the mean. In some countries, it gets up to 90%. And then you have other kinds of impacts, like rice, for example, is contributing 15% of global methane emissions. So no matter how we kind of frame it, agriculture obviously is having a huge impact. And if you kind of pair that with the fact that we have projections of getting close to 10 billion in terms of the global population over the coming decades, and the kind of calorie impact that we have, and thereby the footprint expanding, I think obviously this is a really urgent and a key kind of area that we need to tackle. So anyway, that's kind of framing the context a bit as well. And then just to kind of tie up that introduction, obviously I just mentioned all the huge climate impact, but also obviously agriculture has its role as potentially a victim of climate change, right? So when you think of all the potential extreme weather events or the impact in yields, you kind of can fall into a negative feedback loop. Let's if you think about it, where agriculture is a driver of this kind of climate change, but also is being a victim of it as well. So anyway, that's kind of the situation. But the whole point of this webinar is not to be a bearer of bad news. In fact, the great kind of options that we have in the toolkit can actually promote sustainable agriculture. We're already doing a lot of work with clients around things like regenerative agriculture. So farming practices such as cover cropping, reduced tillage, reduced fertilizer use, crop rotations, which can improve soil health and sequester carbon in the soils. I mentioned rice earlier. That's another area where we are very active, where we can really reduce the methane emissions with fairly simple interventions. And then you have other kinds of interventions, other areas like agroforestry, which we're very keen to promote. So I think that's kind of the angle and the framing that we like to promote in this webinar. And I think we have a great panel here that can give different dimensions to this topic, if that makes sense.
No, that's good, and thanks for framing it and providing very detailed context. I think it's important for everyone to understand what's at stake. And despite the numbers that you've introduced, there are solutions. Initiatives are being taken. They are new technologies that are now being used. You mentioned that you are doing a lot of work with clients to change for regenerative practices. Actually, we that have direct impact from I would say, sustainability practices and context. Nuala, how I would say how are stakeholders, and I don't want to just focus. Maybe we wanted initially to focus on corporates, but maybe more generally, how are stakeholders within the supply chains are tackling and addressing these challenges that John just introduced?
Just to echo John, thank you very much for inviting me to this webinar today. I'm very much looking forward to the discussion. In terms of stakeholders, I think some of the biggest stakeholders that are involved within the agriculture sector is, of course, agri-food companies and companies of where emissions from the agriculture sector actually are probably the bulk of their emission source in their scope 3 category. We've seen, I think, in a lot of few years, is that a lot of companies have begun this kind of understanding of the risk from land use and land use change and the emission sources. Some in the kind of, I would bin them in the compliance category, which is in response to initiatives such as EUDR, where they're kind of de-risking getting rid of deforestation, a deforestation-free supply chain, and so on and so forth. But a lot of companies are kind of really exploring the more voluntary side at the moment of this, which is emission reductions within that scope 3 category of their emissions profile. I think what a lot of them are understanding is that it is very difficult, because a lot of supply chains are not necessarily this easy and transparent to navigate. There is often a lot of intermediaries involved with kind of going from field all the ways to fork. And that also is that when we're talking about agriculture and sustainability in agriculture, outcomes can be variable. They can be quite challenging. So even where we take the accepted science of a lot of these regen ag practices, there is still challenges in terms of implementing them and then monitoring them and reporting on them, and then actually understanding how we can take an intervention and we can turn that into something that is really applicable and will show up in their inventory within their kind of reporting target. So I think what we're seeing as well is we're seeing a lot of companies beginning to make that understanding for them from the ground up. You know what I mean? Really understanding what their supply chain is, where their emission sources are within that supply chain, and begin to invest in pilot initiatives through, interacting with farmers, but then also looking at ag tech companies and digital tools and kind of quantification tools that will kind of translate an investment into a real outcome, into something that they can feel confident in reporting and demonstrating in reality.
That's a good, the investment part is a good segue, because I wanted to ask, you just mentioned that companies are trying to understand. So, we said that in the NBS space, ag or regen ag practices only represent, well, still represent less than 2%, right, of total credits issued. So we see that it's still a nascent subsegment of the NBS market. So Leon, maybe that would be for you, and Nuala and John, please feel free to chime in. But why? I mean, we understand that corporates are trying to make sure they understand their supply chain, their emissions, but yet we're still at the pilot phase or scale.
Yeah, and thanks for that question. I'm assuming you mean why is only 2% of, let's say, volume in carbon markets dedicated to nature-based solutions like this, right?
Yes, because that provides some kind of a certain level of explanation as to why we're lagging, right? So for the regen subsegment.
Yeah, I think what we are seeing, and I'm sharing this from the lens of Rabobank, in some cases being active as a carbon developer and developing our own projects in carbon markets, some of them soil carbon projects. I think the challenge that we see in regen ag type of projects is twofold. One is the complexity in executing them. So the costs associated with measurements and baselining, carbon sequestration models is not an easy task. It's not impossible, but it's very difficult to execute that on a pilot level. It makes sense at scale, but on a pilot level, it's complex, and it's for us difficult to take farmers along in that journey. And second is project costs also relate to carbon credit pricing, obviously, and we see current market willingness to pay for carbon, and not necessarily at the levels that also justify investments in soil carbon. So I think those are challenges that we are seeing. I think it's more relevant, of course, if you look at it from a perspective in setting or using these solutions inside a value chain.
Yeah, no, that makes sense. That makes sense. It's always an opportunity cost risk, right? Assessing whether it makes sense. Ultimately, it's still unfortunately or unfortunately, right? It's still a financial decision at the corporate level. So, and as some I believe the CFO of Salesforce mentioned that until all these topics come to their desk, right, it's still going to be at the pilot level. But yeah. I think we'll get back to this on what solutions are already in place, especially from I would say financing perspective. But maybe John, I think if you want to add that some context as well.
Yeah, I was just going to say, because it is an interesting kind of conundrum, because here with agriculture we are dealing with a system that has worked in terms of scaling and being able to feed the world, and we're talking about systemic change, right? Really changing practices and people's livelihoods. So I think with that, there's always a natural tension. It's hugely different to forestry projects. So when we think of it from the lens of the voluntary carbon market, it's almost as if we're trying to shoehorn a solution that is it's a totally different kind of thing that we're tackling here. That being said, Nuala did touch on this. I feel because we're on the kind of digital MRV side of things, right? So we take satellite data, modeling data, AI, and we provide due diligence and monitoring for these projects. And on that front, and we've done some great work with Rabo as well, if you don't mind me saying, Leon. I think we've seen some really promising signs, right? I think the data are there, and the methods are coming, especially with new AI tools and also ground measurements as well. So I think that bit of the equation and the problem set is coming together. But that being said, I think the business model of actually the voluntary carbon market and connecting it to agriculture, I think that is where it's not really been solved yet. So, I think that's probably the purpose of this whole webinar. But, we have different tools. Luckily, again, it doesn't have to be just the voluntary carbon market. Maybe the VCM is suited to specific types of agriculture. But I think that side of the equation is still something that I think we're still working on, to be honest.
No, yes, that makes perfect sense. Which actually brings into our next topic is market trends and evolution, right? So you touched on it, John, regarding AI, remote sensing, but maybe sometimes you need stronger incentives from your regulators, right? So I'd like to hear from Nuala. What I would say, what have been the major shifts, let's say in the past 12 to 18 months, that are aiming at reshaping how agri supply chains manage carbon and climate risk, and in particular from a regulatory and disclosure perspectives?
Yeah, just to touch on the previous point a little bit, I think there's also a very kind of fundamental reason a little bit about why there is this lack of volume within the carbon market is soil carbon, these kind of projects, which have been the kind of flagship projects for a lot of corporates within the sustainability space, they need time. Soil carbon is something that is kind of, it is in reality, you need a 5, sometimes 10-year time scale to really be able to work out that kind of difference. This is a lot where AI tool or digital tools and AI tools are helping, because in a way, the fact that we're moving from some pilots, which have some of them have been invested in since 2020, we're now moving into that kind of phase of where kind of companies are being able to reevaluate the outcomes and kind of saying, okay, in the real world, not from a research experiment or anything like that, or from a model, we're seeing how this transition works in real time and how big a difference these kind of different sustainable ag practices in different geographies, what emission reductions or removals they're actually delivering, and what then the business model is around that. So I think time has been a great thing in the sense of kind of almost in the next maybe few years, you're going to see that kind of scalability become more viable, because people have begun in the real world to understand the practices, the digital tool, and then the combinations inside of that. In terms of market dynamics, I think one of the big shifts has been probably more the decision by SBTi around offsets, and kind of that has been one of the big kind of shifters in trying to, or in kind of strategies by a lot of companies. I think some companies, even from ag tech providers or project developers or aggregators, in some way had a focus on offset market, but decisions like the SBTi has meant that they've become very nimble and have begun speaking as well about value chain initiatives or insetting kind of projects. It lends a lot of it to that is because those kind of processes are parallel, right? You're either creating a project that is monitoring an emission reduction or a removal in broadly on a scientific basis, right? You know what I mean? But it's kind of the difference between the two of them is if it's occurring within a company's value chain. So an agri-food company can map that kind of removal or emission reduction to a value chain partner, or if it's happening outside of that value chain. So in the voluntary world, I think that has been one of the big kind of things that I've seen. You see a lot more dynamic and nimbleness around that, and shifts of opinion and things like that. And then a lot of initiatives have been, as I mentioned before, is depending on your geography and where you are, is your exposure to these kind of new sustainability initiatives. I think EUDR has been a huge one. You know what I mean? Like, as in companies are very, very concerned about making sure that their supply chain is deforestation free. We've seen a lot of kind of even announcements of companies shifting supply chains because of the risk category to their commodity and things like that. So they're kind of, it's exposing a lot of companies as well to this kind of, concern about emissions from the land use change sector as well, which has been a huge driver, I think.
No, yeah, that's good. Putting together offsets, insets, and allowing companies to account for initiatives done within their supply chains for their scope 3 emissions is expected to be a big game changer. Unfortunately, everything takes time, but we have to anticipate. And I'd like to hear from Leon with, probably have a broad market view with all the clients that the bank has. And what have you seen from the market, from your clients? And do you see also an adoption both from clients, but also within the bank? Are there initiatives that are, I would say, put in place to push the market and clients for Regen Ag?
Yeah, thanks. I think when I look at our clients, I think there's a lot of appetite to talk about initiatives like this, and clients are very eager to learn. Some of them are also very eager to step forward. I think a key example for us also on the insetting side is Lavazza. Rabobank has its own agroforestry program where we generate carbon credits out of agroforestry in coffee and cocoa with smallholder farmers. We identified a few of these farming operations that happen to be in the value chain of Lavazza, and in this case were interesting for them to use as insetting credits. I think that for us is a very clear demand signal from one of our clients that the solutions that we are developing are relevant for them, and might fit a structure like this. I think more in general, when I look at what's happening in the market and the other banks or investors we engage with, I think many of them realize that to be able to invest in soil carbon or regen ag solutions, we need more flexible solutions. I think one of the statistics I read earlier this week is that 99% of capital deployed is still nature negative. So actually has a negative impact on nature. Many of the institutions that we engage with, just like Rabo, are obviously realizing this. I think the interesting perspective there is also that when you see what being nature negative actually means is that the more return, of course, we make, the more it comes at the decline of nature. And there's a linear relationship with that. But when we talk about restoration, it's not a linear relationship. It's still a relationship that we need to figure out, right? How to deploy capital in a nature positive way. And I think that's clearly where you see there's a need for more flexible solutions. We also see that food and ag is a very interesting segment to deploy capital when it comes to a nature positive impact. Carbon abatement costs are relatively low when you compare this to technical solutions. So that's attractive. And it relates to multiple stakeholders that might be willing to chip in. I think maybe another example that we saw of a more flexible solution is one that we deployed together with Coca-Cola. It's a public case where Rabobank, together with Coca-Cola, has set up a 600 million sustainability-linked supply chain program, where suppliers of Coca-Cola feed data up into a platform, and based on carbon, renewable electricity, and reduction target data, we can apply interest rate discounts. And I think that's the type of solution you'd like to see. The challenge is it's not that scalable yet. However, the impact can, of course, be very significant.
No, thank you very much. That's true. We food and agri companies are already in, very, very active. You're right in terms of abatement cost. That is very economical for them. So it makes even more sense. And in particular, when you link the carbon reductions or the sustainability KPIs to interest rate discounts, right? That's even more incentivizing. Before we move on to the next topic, which is 100% linked to what Leon just shared, I'd like to remind the audience to feel free to ask questions in the comments section, and we'll take time towards the end to address some of them. So John, talking about food and agri, let's maybe talk about what's happening on the ground. What's a company like the Climate through its solutions, what is being done, right, on the Regen Ag front, and also if you can touch on whether we're still at the pilot level or if we're seeing a move towards bigger projects or initiatives, if you will.
Yeah, so just to start at the end of your question, Chams, I think where I see digital MRV solutions like our Cyclops solution providing value, in terms of being able to scale from pilot to, large scale projects is, one, obviously reducing the cost in a substantial way of scaling the project and doing monitoring and everything else, while still ensuring that these projects are having the climate impact that we expect and we want, right? So I think if I were to, provide some tangible examples, beyond just the Regen Ag label, which is, obviously to many people, is a specific kind of project type. We do have projects we're looking at, for example, when it comes to agroforestry. So Leon mentioned agroforestry, and this is where, some tools around, using satellite data and machine learning approaches for dynamic baselines, for example, to look at leakage, and then also obviously to look at historic deforestation as well. I think those have become essentially table stakes when it comes to ARR projects. So that's kind of like agroforestry for our purposes. And that's something that I think many of the people involved in the voluntary carbon market especially expect, right? So that's kind of one key kind of set of analysis. Then when I think about rice, and again, it has a huge climate impact, right? 50% of methane. In some countries like Japan, it's 50% of their methane emissions comes from rice cultivation. Here again, we're seeing, the use of our technology, and our team actually has previously worked with Vara and Gold Standard on some of the their rice-related work, looking at, the prevalence of continuous flooding and seeing the transition to alternative wetting and drying. And here, again, that's, a great case study using, in this case, primarily radar satellite data and understanding what exactly is happening on the ground. And then I think kind of the third bucket, if I were to use an example, is what you kind of said in your question, Shams, regenerative agriculture. So things like cover cropping, reduced tillage or conservation tillage, as some call it, and also crop rotations. Here we're using technology to look at things like the historic and the new practices being taken place. So exactly the practices I just mentioned. And also using, and this is actually some of the work I mentioned we did with Rabo previously, leveraging remote sensing data to quantify soil organic carbon. We are at the point now where we can actually leverage optical satellite data and radar satellite data and machine learning approaches to quantify SOC as well. So I think from that perspective, super exciting, right? We have a lot of tools available. We see the new methodologies bringing in those tools. So that's another kind of great, I guess, validation, right? If you look at VM42 with digital soil mapping, and again, that also boils down to stratification of fields, so we can reduce the sampling cost. If we look at VM47 with ARR, that's around, again, the dynamic baseline to ensure additionality and leakage as well being analyzed. And then the new VM51 for rice. All of these methods are bringing in these tools. So I think we have that adoption. But again, to scale, we still need the business model to be really on point. And I think that's still where we're still in the experimental phase, let's call it, I think would be fair to say.
Okay. No, that makes sense. There's a clear need for technology to, I guess, unlock the what is needed, which brings us to basically the role of strategic partnerships. Because you and Leon, John and Leon, you mentioned, that there's a increased appetite from corporates. You mentioned also that you've done a lot of work with ag and food counterparties. So the question maybe is, shouldn't we see more partnerships, strategic partnerships between ag and food companies and tech providers, for example, in order to allow them to quickly assess, the feasibility of a regen ag initiative, right? And we spoke about reducing costs, and it's at the core of basically every issue on Earth. Ultimately, Nuala, what is your view on strategic partnerships?
I think they're becoming more and more important, because particularly for food and ag companies and that are doing insetting, is in a nutshell, they're kind of becoming responsible for and owning the emission reductions and the removals that they're generating within the value chain, and also kind of owning that kind of outcome in a nutshell. And a lot of these companies are creating, sustainable ag initiatives and everything around sustainable agriculture, because at the end of the day, one thing we're talking about emission reduction and a removal, but the principle of sustainable agriculture is a most sustainable food system with no net harm beyond the project boundary as well. So there's a lot of risks associated with that, where on a field, on paper, things might be looking great, but if you're kind of displacing emissions to another area or off your balance sheet, you're not really kind of investing in sustainability. And a lot of companies are I think they're developing these strategic partnerships of companies that understand a lot of these protocols and standards, that have a lot of rules and descriptions around and how to kind of guidance a little bit, how to monitor it and quantify it. They're doing that deliberately to de-risk those kind of outcomes, as in they really want to make sure, in the sense of where they have a project and they're kind of using and they're communicating and demonstrating these emission reductions within their value chain, is that they are real, and in some instances they can demonstrate permanency. So for a soil carbon project, right, the issue will always be about removals and how long and permanent those removals are. It's soil carbon. It's a very difficult concept. It's not like some emission reduction projects like a rice or something with livestock where you're avoiding emissions. So that's kind of different. That's slightly different. You know what I mean? So these partnerships of where kind of companies are making very bespoke, kind of relationships with a digital ad tech company, with an aggregator who is on the ground, who speaks the language of the local farmers, who understands the dynamics about carbon rights, land ownership, and any of those kind of things. They're building more and more, and I would say kind of a lot of the analysis we've seen we've seen the mushrooming, particularly with these kind of core expertise around a concept of a truly sustainable ag project as well.
Thank you, Nuala. So we are getting a lot of very interesting questions that we are going to address in 5 minutes. But before we get to these, there was a very timely report shared by Bloomberg this morning, very, very, very timely, where they interviewed, I believe, around 20 financial institutions regarding regen ag practices and financing. The conclusion is that there is insufficient funding, right, according to their report, which personally I share. Leon, you're on stage here. So what is your view? I mean, we spoke about green financing, sustainability linked instruments, but according to Bloomberg, there's a clear need to having more complex structures with multilateral impact investors, and having also agri-food companies, putting some money down. And there's a lack of traceability, which is what remote sensing and DMRV providers are aiming to solve. So what can we do here? What can you do?
Thanks for that question. I think the solution is in stacking different products or solutions. You should say, I would agree that only green loans or sustainability linked loans are definitely not the end state of how we tackle this issue. It's one of the ways we can take a step forward, and it's one of the ways that we can help clients reduce emissions. But definitely more partnerships with, for example, multilateral development banks need to be in place. I think that's also definitely one of the avenues we are looking at. In addition to stacking revenue sources, maybe another one for us when I look at our processes internally is also the speed at which we are learning to understand new types of project risk is very important. I think when I look at the dialogues happening with us on the business side at Rambo, we all see the opportunities that we can tap into or the role that we can play in sustainability discussions. But when we then relay that information to compliance, legal, and risk, the observations from that side of the business of the company are often very realistic and also need to be taken into account. And I think we still have this internal discussion where both sides, it's still an internal discussion, are still learning a lot from the observations that we have. And I think the only way to learn is by actively looking at tangible cases where we can play a role. And sometimes that is a slow process, but it's a prudent process that needs to happen diligently.
Yes, no, that makes sense. Different avenues, different solutions, but all converging towards the same idea, bringing in capital. So I think it's no, thank you very much. I believe it's time right now to take some of the questions that we've had. So we'd like first to thank the audience for making those very good questions. So let's see if we have the first question here on the screen. All right, so this one is on point and touching on scope 3, touching on the potential limitation of additionality. So I would say maybe Nuala, if you want to summarize basically, what do you believe future collaborations between companies, and we spoke about partnerships, so you can also add tech providers. How can we also help growers, farmers, right, adopt these regen practices, and how can we bring in the lenders, right, to bring the funding that is required in practice?
I think really the most practical way is about understanding each of the stakeholders, understanding the risk involved, right? When we're talking about for farmers, a lot of the investment is on them in a way, because we're asking them firstly to change their business model, but then in some instances put up upfront cost in terms of new machinery. If, for example, we're talking about cover cropping or purchasing more expensive seed technologies and all of these kind of things, and it's kind of taking that risk and then finding a business model that gets the farmer through that risk. Because the issue is that if we do these kind of things not without accounting for that risk properly, what we do is we get this kind of quasi-sustainable system where we have a farmer who's doing one or two interventions that are on paper regen ag, but in practice, as the questioner was pointing out, is that there is a net harm to the environment. So it's kind of basically bringing this upfront cost and investment and risk sharing with the farmer first and foremost, and understanding that on all of these stakeholders. So this can be the lender, this can be the agri-food company or whoever, and kind of co-sharing to get through that transition. Because usually after that transition, what we find is yields begin to stabilize. Farmers can then, hopefully begin to actually reduce their inputs because their soil health is reversing and all of these things. You know what I mean? If we do things without that conversation, without that risk mapping first, I think we'll always end up in this kind of regen ag light kind of scenario where the intentions are really good, but the investments are not being returned because we're not delivering the outcomes that we're really needing to see for the farmer, but also for whoever is investing in the process as well.
I think we have another one comment on that, asking whether it's the farmer's role. John, you want to compliment?
I don't know if this is what Kevin's question is kind of touching on as well, but it is a real tension in terms of additionality and agricultural carbon markets, let's just say, because by definition you are penalizing those pioneer farmers who may have been doing these regenerative practices for decades or even generations in some instances. So that's where non-VCM related methods, so maybe value chain like Nuala kind of mentioned, could be more fit for purpose in those circumstances. It's interesting because one of the few environmentally related tax programs which survived the Big Beautiful Bill was around 45Z, right? And that's incentivizing farmers around biofuel. And there, if you are a pioneer and you have a low carbon intensity score, you actually would benefit in a big way. So again, it's going to be different kind of methods would be targeted based on what's appropriate. But it is a good point in terms of additionality, voluntary carbon market, and agriculture. That's always been a kind of central tension, I would say, in designing these programs.
Yep. That makes a lot of sense. But and if I can add something, is ultimately is what is the incentive, right? You're a farmer, you're a grower, you're being told that your ag practices are emitting too much carb or CO2 equivalent. Let's call it like this. So what are the solutions? One of them is by changing cover cropping, no tillage, but that ultimately may reduce your yield. If you reduce your yield, you lose revenues. You're a farmer, right? You're at the start of the supply chain, and you're asked the question, okay, so what's the alternative? And there's a carbon market, there's in setting of setting, but there's also this issue of time between changing practices, losing revenues, and getting money from those programs. Um, Talking about programs and initiatives, there's a very good question. So, where we are, so the question is that we're focusing on NBS projects. There are all other issues, and one of them being the desertified and soil affected lands. I think if we can have the question on screen, that'd be great. Otherwise, yeah. Um, so those are desertified and soil affected lands are growing fast, yet often overlooked. So the general question is, how do we choose projects? I mean, are we focusing on the right ones, um, and why are we investing in certain types of regen projects versus others? The floor is yours. Leon, since we're talking about investing, what are the metrics or what are the decision tools that are used by a financial institution to choose?
Yeah. I would say, yeah, it's an interesting question, but it shouldn't be an either or question. It should be an and question. Like, how do we also invest in the other topics mentioned? I think for us, it's primarily a business case, right? That needs to work. And it should be more or less proven technology that has a track record and that justifies an investment. And I think maybe speaking from the role of Rabo as a developer in the carbon space, you could argue, given the other examples mentioned, like desertification and salt affected lands, yes, they are also very difficult to target, but maybe the ones that we've been already looking at, agroforestry, reforestation, and soil carbon, you could consider them almost low-hanging fruit when you look at these two other examples, and they are already so extremely difficult to solve, right? And maybe that's just the beginning of all the other climate-related challenges that we need to look at. So I think it's a combination of business case and also viability of solutions and deploying them at scale, which is just a very difficult estimate to make.
Yep. It's a risk reward ultimately, which brings us to a very good very good question on how to reduce risks. There are different tools, insurance being one of them, and there's a potential avenue using parametric insurance. So the question is parametric insurance being used in regen ag? And keen to know if lenders or underwriters view as way to reduce the risks.
Yeah, that's my short answer. Yes, it's a good solution. I think in our innovation team, where we sit with Carbon Bank, we're also looking at how we can use insurance products in different avenues. Yeah, so I definitely think it's an interesting angle. Definitely a way to, in carbon markets, at least to reduce delivery risk of carbon credits, and therefore adhere to longer term offtake agreements with which can generate cash flow for debt service. So I think it definitely adds an important piece to the puzzle of how we can be involved in this market.
Yeah, and the beauty, I would say, of parametric insurance is that it's binary, basically, right? Something happens, and you trigger a payout. So That is in the pipeline. We know different actors looking seriously at implementing a parametric insurance for regen practices. I forgot to add. So first, thanks everyone for the questions. We won't be able to address all of them. With that being said, we will follow up and answer, and we'll post them onto our webinar blog. I think it's time. Yeah.
James, just quickly, because I just
Oh,
want
yeah,
to
of course.
clarify something based on what Kevin just said. To be clear, you cannot sign up for both 45Z and the greenhouse gas program at the same time if anyone is planning to do so. I think the uptake of programs like 45Z would be up to the programs that will be designed by the biofuel producers themselves, and how much sharing they will be looking to do with the farmers in the end of the day. So that's something that we'll probably find out about over the coming months and the coming year as well. But it is an interesting model, I would say, and the economics on paper do look a lot more attractive from a farmer perspective, definitely from a biofuel producer perspective, than you would expect from a voluntary carbon market at current carbon prices, I would say. So just a point of clarification on that matter.
No, thank you. No, that was important to make that clarification. I think it's time to wrap this up. So it was a delight, but before, I'd like to hear one more time from our panelists, right? As you said, John, we want to shed an optimistic view, right, about how to scale and how to make real impacts. So if each of you could, provide your positive view on how you see the specific market progress in the next 12 to 18 months. And it's open floor. And I will start with Nuala. You're on the spot.
I think in a lot of kind of looking at like this landscape and this ecosystem of sustainability, farmers, finance models, MRVs and quantification things, I think it's been very interesting to watch this kind of translation of the science and the kind of the technology around sustainability into kind of the more kind of into now conversations about how do we kind of create finance models. I will say models rather than model. And that has been really heartening in the sense of there's a lot of exploration about what is the best model in which geography and what suits the kind of commodity and everything most, and kind of this risk sharing analysis as well, is that how do we bring these emission reductions and these practice changes to the farmer, but that whoever is kind of the partner in there, be it the value chain partner or the project developer or the banker, everyone is kind of figuring out how to share this risk across that business model, which is kind of, it's just really heartening to see because it brings that likelihood of success, you know what I mean, during particularly that transition period up. And I think that's one of the really nice things that I've seen and hope to see more and more of over the next kind of 18 months as well.
Thank you. Leon, please.
Yeah, a positive note on the future. I think I'm speaking, of course, with a carbon lens. And I think a positive note on the future will be that this market continues to be around and seems to be developing in an even better, higher integrity, higher quality market. When we look at data from the market, that seems to happen despite political sentiment in the US and also in some countries in Europe. So we see that it's still a voluntary market, and our corporate clients continue to use this voluntary market despite a challenging environment that they operate in, and it is progressing into a higher quality, higher integrity market. So I think that provides a good base for more creative financial solutions that can address farm health and sustainability.
Good. Thank you. John.
Yeah, I saw one of the questions around remote sensing, and having been using remote sensing approaches and what the team has been doing, I would take the other side of that, because pairing remote sensing with some ground measurement, I think, and I think we've seen this in many projects, is the only way to scale it. Because if you think about it, with remote sensing, we essentially can sample across fields, which are naturally very heterogeneous, right? So, I would encourage anyone who wants to dive a bit deeper on that. We've done a lot of work on it, so please reach out. But, with more sensors coming in, hyperspectral sensors coming in as well, we're only just touching the tip of the iceberg when it comes to the capability and the utility of scaling with remotely sensor approaches, again, with machine learning and some ground measurement as well. So I'm very optimistic when it comes to that. Anyone wants to discuss, please reach out to the team.
No, absolutely. And just to conclude, we spoke about traceability, and the Bloomberg report touched on that. We have a solution, right? It's project agnostic, it's outcome agnostic. It's really there to provide an independent assessment of viability, the amount of carbon that is being sequestered. So remote sensing combined with the willingness of corporates to invest, supported by their lenders, I think we have our own supply chain here, right? Remote sensing provider, corporates, and lenders. So, well, just some closing remarks. I'd like again to thank the three of you. That was very, very fun to moderate. We'd like to thank our audience and remind everyone that if we weren't able to answer your questions, we'll try to answer them and have a follow-up post on our blog. Also, we'll have a playback on YouTube and the StreamYard platforms after the recording finishes. And if I may quote a philosopher, right? Basically, from carbon markets and beyond, actually is to infinity and beyond. For those that have recognized that it comes from Buzz Lightyear from the movie Toy Story. So I'll finish on that positive note. Once again, thanks everyone, and please reach out to any of us here if you want to follow up and explore some of the solutions that were discussed today. Thank you.